Saving for retirement is one of the most important financial goals that individuals need to plan for over their lifetime. With the rising cost of living, increasing healthcare expenses, and uncertainties around the future of government pension programs like Social Security, it is essential to take proactive steps to ensure financial security during retirement. Two of the most popular retirement savings vehicles in the United States are individual retirement accounts, IRAs, and 401k plans. Both offer significant tax advantages and can help individuals accumulate wealth for retirement. But there are key differences between the two that can impact how and when you save. This essay explores the nuances of IRAs and 401ks, outlining their similarities and differences to help you make informed decisions about your retirement planning. 1. The basics of IRAs. An individual retirement account, IRA, is a personal retirement savings account that provides tax advantages to encourage long-term saving. IRAs are not tied to an employer, meaning that any individual with earned income can open and contribute to one. There are two primary types of IRAs: traditional IRAs and Roth IRAs. The traditional IRA allows individuals to make pre-tax contributions, which can lower their taxable income for the year in which the contributions are made. The benefit of this structure is that it defers taxes until retirement when the money is withdrawn. Roth IRAs, on the other hand, require after-tax contributions, meaning you do not get an upfront tax deduction. However, the key advantage of Roth IRAs is that withdrawals during retirement are tax-free, including any investment gains, which can be beneficial if you expect to be in a higher tax bracket later in life. 2. The basics of 401 as a 401k is a retirement savings plan sponsored by employers. These plans allow employees to save and invest part of their paycheck before taxes are deducted. Like a traditional IRA, contributions to a 401k are made with pre-tax dollars, reducing your taxable income in the year you contribute. This tax-deferred growth allows investments in the account to compound over time without the drag of annual taxes. Additionally, many employers offer a Roth 401k option, where contributions are made after taxes, allowing for tax-free withdrawals in retirement. One of the standout features of the 401k plan is the employer match. Many employers match employee contributions up to a certain percentage of the employee's salary, effectively offering free money to boost retirement savings, which is a significant benefit over IRAs. 3. Contribution limits for IRAs and 401ks. One of the major differences between IRAs and 401k is the annual contribution limits, which can influence how quickly you can build your retirement savings. As of 2024, the maximum contribution limit for IRAs is $7,000 per year for individuals under the age of 50, with an additional $1,500 allowed for those aged 50 and older, bringing their total to $8,500. In contrast, the 401k contribution limits are much higher, with employees under 50 allowed to contribute up to $23,000 annually, and those over 50 can contribute an additional $7,500 in catch-up contributions, for a total of $30,500. The higher contribution limits of a 401k make it a more powerful tool for those who want to maximize their retirement savings. However, individuals with IRAs can also benefit from contributing smaller amounts over a long period, especially if they utilize a Roth IRA for its tax-free growth potential. 4. Tax advantages of IRAs. IRAs offer significant tax advantages that make them attractive for long-term retirement savings. With a traditional IRA, contributions are tax-deductible, meaning that you reduce your taxable income in the year you make the contribution. This allows your money to grow tax-deferred, meaning you won't pay taxes on any investment gains or dividends until you begin taking withdrawals during retirement. This can be a big advantage if you expect to be in a lower tax bracket when you retire. In contrast, Roth IRAs do not offer an upfront tax deduction since contributions are made with after-tax dollars. However, the trade-off is that qualified withdrawals in retirement, including any earnings on your investments, are completely tax-free. This can be particularly advantageous for individuals who expect to be in a higher tax bracket during their retirement years. 5. Tax advantages of 401k KAs 401k plans also provide substantial tax benefits. With a traditional 401k, contributions are made with pre-tax dollars, which reduces your taxable income in the year you contribute. This allows your savings to grow tax-deferred, meaning that taxes are only due when you begin withdrawing money in retirement. For many people, this means paying taxes on their 401k withdrawals at a lower rate, as their income may be lower in retirement than during their working years. A Roth 401k offers a different tax advantage, where contributions are made with after-tax income, but withdrawals in retirement, including any investment gains, are completely tax-free. This structure is similar to a Roth IRA, but with higher contribution limits, making it an appealing option for higher income earners who expect to face higher taxes later in life. 6. Investment options in IRAs. IRAs generally offer greater flexibility in terms of investment choices. When you open an IRA through a financial institution, you can typically invest in a wide variety of assets, including stocks, bonds, mutual funds, ETFs, exchange-traded funds, real estate, and more. This broad range of options allows for greater control over your investment strategy, which can be advantageous for experienced investors looking to tailor their portfolios to their risk tolerance and goals. Additionally, since IRAs are not tied to an employer, you are free to move your account to different institutions if you find better investment opportunities or lower fees elsewhere. This flexibility makes IRAs an attractive option for those who want to take a more active role in managing their retirement savings. 7. Investment options in 401 KK's 401k plans, while offering tax advantages and employer matching, tend to have more limited investment options. Employers typically offer a set list of mutual funds or target date funds, which are professionally managed and designed to simplify investment decisions. While these options may include a mix of stocks, bonds, and other asset classes, the choices are often more restricted than what is available through an IRA. However, the investment options in a 401k are curated by professionals, which can be a benefit for employees who are less experienced or prefer a hands-off approach to investing. Additionally, some 401k plans offer a self-directed brokerage option, allowing participants to invest in a broader range of assets, but this feature is not as common and may come with higher fees. 8. Withdrawals and required minimum distributions, RMDs. Both IRAs and 401ks have rules governing when you can begin withdrawing funds without penalty and when you are required to start taking distributions. For traditional IRAs and 401ks, you must start taking required minimum distributions, RMDs, at age 73. These are mandatory withdrawals based on the balance of your account and your life expectancy, and they are taxed as ordinary income. Roth IRAs, however, do not have RMDs, which gives you more flexibility in deciding when and how to take withdrawals in retirement. This can be particularly useful for estate planning, as Roth IRA funds can continue to grow tax-free throughout your lifetime. Roth 401ks, on the other hand, are subject to RMDs. But this requirement can be avoided if you roll the Roth 401k into a Roth IRA before RMDs begin. 9. Early withdrawal penalties. Both IRAs and 401ks discourage early withdrawals by imposing penalties if you take money out before age 59.5. In a traditional IRA or 401k, early withdrawals are subject to a 10% penalty on top of the regular income taxes due on the distribution. There are some exceptions to this rule, such as withdrawals for qualified medical expenses, first-time home purchases, in the case of IRAs, or certain education expenses. Roth IRAs offer more flexibility, allowing you to withdraw your contributions, but not earnings, at any time without penalty. This feature can be beneficial for those who want to retain access to their savings for emergencies or other financial goals while still growing their retirement nest egg. Roth 401ks, like traditional 401ks, are subject to early withdrawal penalties unless you meet specific conditions, such as financial hardship. Saving for retirement requires careful planning and an understanding of the various tools available to you. Both IRAs and 401ks offer significant tax advantages that can help you grow your retirement savings over time. However, they differ in terms of contribution limits, investment options, tax treatment, and the availability of employer matching. By understanding these differences and aligning your choices with your long-term financial goals, you can create a retirement savings strategy that maximizes your potential for financial security in your later years. Whether you choose an IRA, a 401k, or a combination of both, starting early and saving consistently is the key to a comfortable and worry-free retirement.